What's up, everybody? It's your boy Sat coming to you with today's stock pick, indicator help, and general investment tips. Remember, this channel is all about no face, just facts in 5. I do the research so you don't have to. Shout out to 11 Labs for making every video possible with their next gen voice cloning and text to speech tools. Link in the description and profile. Let's dive in. Today, we are breaking down a massive paradox hitting the software sector as we approach a critical earnings event. Adobe, trading under the ticker symbol ADBE on the NASDAQ, reports its second quarter results after the market closes today. Heading into this release, the stock has experienced notable pressure, dropping 17% since the start of June to tumble down from $274 to a low of $225.66. Is this drop a buy the dip play or a hype trap? To understand the underlying battleground, we have to look closely at what Adobe actually provides. Adobe is the undisputed global king of creative tools, powering design pipelines with applications like Photoshop and Illustrator. However, their modern growth story centers completely around their new Firefly Generative Artificial Intelligence suite. The entire market is keeping a cautious eye on this call to see if Adobe can successfully embed automated design tools into their recurring revenue model, or if they are merely absorbing sky-high computing costs to run these models without showing sufficient incremental profit. Let us look at the raw corporate data and catalysts guiding this release. For the second quarter, management guided for revenue between $6.43 billion and $6.48 billion, with non-GAAP earnings per share expected between $5.80 and $5.85. Consensus is modeled at $5.83, a 15% increase year over year. A major fundamental safety cushion is the newly approved $25 billion stock repurchase program, proving leadership believes shares are discounted. Moving over to the daily chart, the price action reveals an intense story of liquidation ahead of the numbers. This recent decline means the price has sliced cleanly beneath both its short-term and long-term moving averages, handing immediate control to the bears. The stock is currently trading right at the absolute edge of its 52-week low range, which rests at $224.13. Trading volume has started to pick up heavily as we head toward the close, signaling that institutional desks are actively repositioning their portfolios for the post-market print. Isolating the indicators gives us a clean look at the exact data story playing out right now. The 14-day RSI has crashed into the low 30s, indicating that pre-earnings selling has pushed the stock into deeply oversold territory. The price action is pressing aggressively below the lower rail of the Bollinger Bands, proving that the short-term downward stretch has reached its boundaries. Meanwhile, the MACD tool confirms this velocity, showing lines cross negative with red bars on the MACD histogram expanding downward to show sellers hold the wheel. Let us outline the critical price boundaries you need to watch when the numbers hit. Your immediate overhead resistance ceiling sits at $233. If a surprise triggers a breakout above $233, it clears the technical pathway for a run back toward $256. On the flip side, if management delivers a soft outlook, your primary support zone is anchored right at the 52-week low of $224, which is your ultimate line in the sand. We must have an honest conversation about risks because even blue-chip software giants carry heavy warnings. Adobe faces a massive wave of tech competition from new generative design tools threatening their market share. Furthermore, capital expenditures are rising rapidly as they spend heavily on infrastructure to keep processing speeds competitive. If their recurring revenue trajectory encounters roadblocks, these heavy costs could put a serious squeeze on profit margins and force analysts to downgrade growth targets. From a strategic standpoint, this setup represents a classic momentum play sitting at a vital technical crossroads. The underlying business remains highly profitable, but the short-term indicators show a stock that has been completely maxed out to the downside. The smart move here is to let the initial after-hours volatility settle down completely and monitor how the price handles the $224 macro floor. Wait for the MACD histogram bars to begin shrinking to confirm that selling velocity has dried up, keeping your position sizing controlled while this story plays out. Remember, I'm not a financial advisor and this is not financial advice. Always do your own research before investing. If you found value in today's video, hit that like button, subscribe, and share it with someone who's just beginning their investing journey. This is Sat with Stocks by Sat06. No face, just facts in 5. Keep learning, keep investing, keep building. Peace.